Unfortunately, we are all in the middle right now of a global health pandemic. This is a very scary time for many people, and my heart goes out to everyone who is affected by this crisis. This virus is spreading, and my thoughts and prayers go out to the entire globe at this time. Being a channel about dividend stock investing and personal finance, I do want to take an opportunity today to update everyone on my personal investing strategy. Today's video, it has 3 parts. I'm going to start with the 3 stocks that I purchased just last week as the stock market has literally started crashing. I'm then going to talk about 6 lessons that I have learned so far from this stock market crash, this economic time of uncertainty. I've learned a lot of lessons so far, many of them which I summarized in my previous videos, which I'll link to in the description below. But I continue to learn during this time. What I've always found is in a time of turmoil, in a time of challenge, the learning and the lessons, they come a bit quicker. And so I've learned 6 more things that I want to share in today's video. And then I'm going to end the video today with my forecast of what's to come in current weeks and months, how I'm going to approach it, and what it means for me as a dividend stock investor. As I've said all along on my channel here, I am literally just sharing my personal journey. I do not offer investment advice. I'm not a licensed financial advisor. I just share my journey here on YouTube for fun and entertainment. And so I always mention that in my videos, and I also have a disclaimer in my video description below. I please invite you to check that out, because investing in the stock market, especially during these uncertain times, carries a lot of risk. That being said, as a long-term buy and hold forever dividend investor, my strategy during these uncertain times is one of dollar cost averaging. So I continue to buy into the stock market. I bought 3 stocks last week, and going into future weeks here, I believe the market is going to trend down a lot more. I would not be surprised if the Dow hits 20,000, maybe even 15,000. I'm going to be averaging all the way down and all the way back up, as I always do. Good markets, bad markets, good economies, bad economies, happy times, unhappy times. For me, it is dividend stocks, dividend investing all day, every day. That's what I'm about from a personal finance perspective. So it is in my blood. It is in my character to always be deploying money in the stock market. Now, this may not make sense for other people out there. It probably does not. Everyone has to evaluate their own situation. Everyone has to evaluate their risk tolerance. And I am just sharing my personal journey here on YouTube. And I will continue to do that throughout this entire time of uncertainty. So I want to get started. Let's kick off today's dividend stock video. All right, everyone. So I want to get started first with the 3 stocks that I purchased last week. I noticed last week that the stock market was tumbling. It was starting to crash. Personally, I believe there's going to be a lot more crash. But despite whatever I believe, I like to dollar cost average in because I cannot forecast the market. I just can't. I don't know where the market is going. And so all I can do is dollar cost average. And certainly I believe that in the long term, my purchases at current share prices will be rewarding, although I do think there could be further share price declines ahead. And so let's start with the first one. I'm going to put this on the screen right now. I went ahead and I purchased more shares of StarBucks, and StarBucks is a company that I love. I haven't been spending a lot of time there lately because I have been trying to practice social isolation, as has been recommended by the authorities out there, in order to help soften the spread of this nasty virus. That being said, when the good times are back, I will celebrate by going to Starbucks every day. I will do that again, and I'll see how much money I can spend at Starbucks. But until then, I am spending my money on Starbucks stock. And so I purchased some more shares at $68.08. This is a starting dividend yield of 2.41%. And worth noting, the analysts are already revising the earnings per share estimates down. So I bought some Starbucks, another tranche recently, and when I did my last analysis, the analysts expected them to earn $3 per share in 2020. Now they're expected in 2020 to earn $2.85, and so that analysis from the analysts, it's already trending down. Why is that? Starbucks actually just shared a report, an update, if you will, with investors on their China division and what's gone down in China during the virus issues there. And it was not pretty. Their Chinese business, comparable stores, same-store sales during the month of February were down 78% year over year. Let me repeat that. Based on Starbucks themselves telling investors what's going on in China, and bless you, Starbucks, for being so transparent with all of us, they are saying in the month of February, 78% fewer same-store sales. And so as this virus spreads to other countries, unfortunately, this same effect probably will happen worldwide. Maybe not as pronounced as in China, but what I would say is personally, I'm expecting EPS to trend down quite a bit more for this company. And so when EPS trends down, PE ratio goes up. And so my latest tranche was at a PE forward of 23.89. And thankfully, as you can see here on the screen, Starbucks does not carry a tremendous amount of debt. Only, I guess, it's still a lot, but given the scale of the company, it's not so bad. It's $20 billion, and their 5-year dividend compound annual growth rate is a 20.7%. And so, for me, there's kind of a few takeaways here. First takeaway is, does earnings per share forecasts in this kind of environment really matter? Yes and no. 2020, I'm just telling you all, it's going to be a bad year. The numbers from the types of companies, a lot of the types of companies I own, like Starbucks, they're not going to be good. They're going to be horrible. It's going to be horrible earnings. That being said, if you kind of put 2020 aside and assume by 2021 or 2022, things get back to normal, it probably makes more sense to model on those years, because literally this year, it's going to be written off. It's going to be a very poor year. And so at this time, for companies like Starbucks, I'm not really only looking at the forward PE and the EPS estimates. I'm also just looking at raw stock price. Where is the stock price versus its recent lows? And quite frankly, Starbucks has lower to go. I would not be surprised if in coming weeks I'm buying some Starbucks in the $50 range, maybe the $40 range. We will see. I think the crisis is going to hit them hard, but they'll make it, and I think they'll be back to normal in a matter of years. Thankfully for me, I'm buy and hold forever. I'm in no rush, and so I am okay waiting 5 years, 10 years for these investments to pan out. And being a family man with kids, I'm looking multi-generational as well. And so some of the steps I'm taking today hopefully will bear fruit for future generations within my family. And so that's how I'm looking at it. Certainly, the perspective I'm giving today is not someone who needs to retire soon or someone who needs access to money soon, because investing money right now in this market, it is truly unprecedented. We have not seen anything like this before. I have not seen anything like this before. And so for me, as someone deploying capital in this kind of market, it's really key that I don't need access to this capital for a long time, because, again, in my lifetime, in my investing career, I've not lived through something like this before. It is very, very different. And because of that, creates a lot of risk, might create some opportunity, but the time horizon, the investing time horizon, it gets stretched out a lot more because of something like this. And so the other takeaway I would say from China, from Starbucks, is things could be worse than we all think, and I'll tell you why. China also said, hey, February was bad. Same-store sales were down 78%. But they also went on to say things are coming back pretty quickly now. But I'll tell you the reason they're coming back quickly. China is a very different culture than the United States. Right now, to go into a Starbucks in China, based on their press release, my understanding is people are getting their temperature taken. My understanding is Starbucks is giving customers a mask to wear in the store. My understanding is in the store, there is no contact between customers and the baristas. There is technology that has been developed there literally to allow it so it's a touchless experience. The baristas and the customers don't have to come in close contact. And so all I'm saying is China, it's a different culture there. I think one of the reasons the virus got better and things got better so quickly there is because of their culture and because the citizens there are more open to things like social isolation and listening to authority and doing as authority says, where in the U.S. it's more of a, hey, land of the free, land of freedom, I'm going to do what I want. These are some things just to keep in mind because, like I said, things are coming back in China, but literally Starbucks, as they go into Starbucks, they're being given a mask. As they go into Starbucks, they're literally getting their temperature taken before they go into Starbucks. If something like this, it may not happen in the United States. I don't know if culture in the U.S. would accept that. And because of that, the point I'm trying to make is this quick recovery in China, supposedly Starbucks, I'm glad they shared this and I'm glad they're transparent. It gives me a lot of faith in the company, but I am preparing for the worst. I am preparing for the recovery in the U.S. to take substantially longer, potentially, than China. But like I said, buy and hold forever, dividend investor, time frame long in the future. And I'll tell you the extent of my time frame. Even if my investments don't give me huge returns or huge satisfaction in my lifetime, I'm okay with that. I'm looking multi-generational. Now, I hope I get to enjoy it. My goal, obviously, is to live off of dividend income in my lifetime and to enjoy the fruits of my labor in my lifetime. But I'm prepared. I am prepared for anything. And so I just think it's very important to share that context with the community. I'm not trying to spread fear. I'm not trying to discourage, but I'm trying to be realistic with myself. And I'll tell you, sometimes it's a trick I play with myself. I will trick myself just into thinking, hey, I'm comfortable with this worst case. And sometimes the worst case, it's a really, really bad worst case. I do that because then anything that happens for me as an investor or in life, it will top those expectations and I'll be one happy camper. And so that's how I oftentimes look at things. All right, moving on. The second stock that I purchased last week was 3M. It's so funny. I just keep averaging down on this thing. And I'm okay with that. I'm okay with that because I keep getting better and better prices on 3M. And so last week it was going really, really low. It was selling at $134.40. I'll share this all on the screen right now. That puts the starting dividend yield at a 4.38%. That is massive for 3M. The forward PE is now to 14, although I think that PE is going to go up because I think the analysts are not fully incorporating how bad this crisis is going to be on 3M. They will pick up business in their mask division. The rest of the company is going to face pain as part of a global economic slowdown. And so I think that the PE, the forward PE here, is probably more generous than it will be. I think it's going to be higher. And so something to keep in mind. The debt is manageable at 3M. Again, for a company of their size to have only 20 billion, 21 billion, I feel good about that. The dividend is growing. And so I was happy to average down, and I will continue to. I'll tell you, I am focused now on Starbucks and 3M because I want to build both of those positions a lot bigger in my portfolio. They're both, I would say, roughly half the size of where I'd like them to be. So I'll just keep going. I'm going to keep going on both of those. Those are two of the stocks I'm really focused on in this downturn. And I think this downturn, by the way, could last a while. I don't think it's going to be a quick fix. I don't think this bear market, stocks are up Friday. No, that was a bear market rally. They're going to be down again. If not next week, the week after. I think this is going to be a downward stock market. Again, I am prepared to lose, say, 50 or more % of my money on paper in my stock market, knowing how long my time horizon is and knowing that I'm going to be accumulating shares at these lower prices during these unprecedented times. But I might be in a very unique and different situation than a lot of other people out there. I'm just sharing my own journey. And so with 3M, I'll just tell you, I keep averaging down. That's really my takeaway, is how low can it go? It's probably going to go lower. I'll keep averaging down, and then when it turns around, I'll keep averaging up. And so that's how it is for me. I cannot time the market, and so I'm always dollar cost averaging. All right, I want to share the third stock that I bought last week, and this one was more of an impulse buy. If you've been following my channel here, and I'll link in the description below, I set forth rules for myself during this downturn. And the rules are, Ian, you should just buy your ride or die stocks. I'm going to share those on the screen right now. These are your favorite stocks. These are the ones you feel best buying. These are the ones that are going to weather any storm more or less over the long term. These are the ones you should focus on. Okay, I was going to stick with my ride or die stocks, but then all of a sudden CEDAR FAIR started plummeting, and so I bought some. I actually instantly regretted it, and I bought some Starbucks right after just to kind of make myself feel better. I didn't regret it because it's a bad company or there's anything wrong with it. I regretted it because I didn't follow my own strategy, and that was actually a takeaway that I'm going to discuss with all of you in a bit, that even after I set out a strategy, even though I've been investing for over 20 years, in this market, in this economy, in this global unprecedented crisis, it's hard sometimes, difficult to think logically, and I saw CEDAR FAIR plummeting, and I just went for it. And this is probably one of the riskier stocks I own. I would have never guessed it because these are unprecedented times. Who would have thought that a global pandemic would come our way in 2020? But the reason this is so risky is they operate amusement parks. And given that the CDC, given that the government is advising Americans to distance socially, the CEDAR FAIR came out and said that they're going to open their parks on schedule, but we'll see. I don't know how long that will last for them because that's kind of the opposite of social distancing. I don't know if that is something that's going to be best for our society. We will see. Nonetheless, I bought CEDAR FAIR as it was tanking. It actually tanked another 30% the day after I bought it, but then it rallied up the day after that, and so it's kind of trading around where I bought it now, but I bought it $27.37. That implies a starting dividend yield of 13.66%, and it's just interesting. The market cap right now is $1.5 billion. This thing is basically trading, in my opinion, as if it's going to be non-operational here for a while. And I wouldn't be surprised. I know CEDAR FAIR came out. They said they're going to open the parks on time. Stock rallied on that news. But again, if this global pandemic gets worse, they probably will be forced to close their parks. I am no expert at amusement parks, but logic would tell me where I live in the Greater Bay Area right now, they're telling people to limit social gatherings. They're saying if you have a social gathering of 50 or more people, you are actually going against the law at this time. You're not supposed to do that. And so all I'm just saying is I know CEDAR FAIR operates a lot of different parks, and some of them may be able to open, some of them may not. But I'm just saying if this crisis gets worse, I'm prepared for the worst. And with CEDAR FAIR, I'm basically prepared that they may suspend the dividend here for a year or two, maybe more, and that the stock faces further downside. But the way I was looking at it when I bought it, the logic that went through my mind is, look, it's trading really cheap. I know the dividend may get suspended, but I also know I'm a really long-term investor, and I know it'll come back. And when it does come back, I'm going to be yielding 13+%, and I felt like that was worth taking the risk. That being said, I broke my own rule. Yeah, the rules are kind of there just to guide me in one direction, but I'll tell you, going forward, for me to stay kind of sane, for me to stay on point, for me to be happy, I got to stick to my ride or die stocks here on out. And I broke the rule one time, but it was a learning lesson, and we'll see how CEDAR FAIR goes. I wish them the best. I think I bought it at a value price. But again, these unprecedented times we're in are definitely giving even me, a seasoned investor, a lot to think about. And that's a takeaway as well. I get comments here, Ian, you should have seen this coming. Ian, I saw this coming. I prepared for this. I'll tell you, maybe there are some people that saw it coming, more power to you. I wish those kind of people would be more vocal and share with the community their thoughts. But I'll tell you, most people, I don't think they envisioned that 2020 was going to be a year of a huge global pandemic. And so people ask, Ian, why were you averaging into stocks at higher prices? The reason I was averaging in at higher prices is that's what I do. I'm sharing my journey here. That's part of my journey. I'm always averaging into the stock market in both up markets and down markets. And now it's going down. And so I'm averaging in. And am I happy about this correction? Honestly, I'll tell you, for a dividend investor, there's a lot of people getting happy. They're like, hey, I'm buying these stocks at lower prices. But I'll tell you, I'm not that happy. And I'll tell you, it's not even the paper loss. I don't care about that. I just care about cash flow from dividends. But the reason I'm not as happy as a lot of people in the community is I see beyond the market crash. I see a significant economic impact happening here from this crisis. And what it means is, yeah, I'm buying Starbucks cheaper. Yeah, I'm buying CEDAR FAIR cheaper. But this crisis, it is going to impact these businesses in a big way. And what that means for these businesses is, yeah, I'm buying it cheaper, but the game has changed. The game has changed for these guys. And so, yeah, I'm always buying, like I said, dividends all day, every day. It's what I am. It's in my core. But I have mixed feelings about this. Certainly on the one hand, the most valuable thing that is out there is human life. And so I am totally bummed out about this global pandemic, and I pray for everyone's health and wellness out there. I actually said this on my Facebook community, and I'm going to say it here. If you or someone you know is facing challenge right now because of this virus, please, and you want my prayer, please put in the comments below. And not only will I pray for you, but I am certain there are other members of this community. Let's support each other. We will pray for each other here. And so that's like, someone has asked me, Ian, are you excited about this? Heck no, I'm not excited about this, because the worst thing that could happen is loss of human life. That's the most valuable thing. Who cares about the stock market? Human life is the most valuable thing. And so that's my first reaction. Now, putting that aside though, am I happy the stock market is down? No, because the game has changed. This is something I could have never envisioned. Global pandemic. It's crazy. It's unprecedented, unfathomable. But given that it is happening, I'm going to average down. But like I said, the economy, the game here, at least in the short run, it's changing quite a bit. It is changing, in my humble opinion. But like I said, my timeline is so long. Even if I don't see the benefits of this in my lifetime, that's how long my timeline is, because I live on into the future through future generations. But we'll see. We'll see how that goes. Again, I don't want to scare anyone out there, but I have to set realistic expectations for myself and the community, because I don't know if everyone is taking this quite as seriously as it should be. All right, and so I want to transition now into the second segment of today's video. I'm going to go through 6 lessons that I've learned recently from this crisis. And this is in addition to the lessons that I shared the other day. I'll link to my recent videos in the description below. And I'm going to go through some of these lessons. What I've found is in times of crisis, oftentimes the lessons, they come a bit quicker. So I'm going to go through 6 of those right now. Now, before I even get into that, I do want to just let you know, I have a bit of a head cold today, and so I hope the video is coming across okay. I have a bit of congestion in my head right now, but it's important to me to get this video out to all of you in real time, because there's so much going on in our world, and I want the community to know what I'm doing in my personal journey, because I know a lot of you follow my journey. You want to know what I'm doing. You want to know what I think during these times, and so I got to share that with all of you. But I know the production quality of the video today may not be quite as good, but I got to get it out for you all, thug lifestyle. So takeaway 1, lesson number 1, is things can change really, really quickly. And so one of the things I learned is I would have never guessed that a global pandemic is coming. I don't think most people didn't. Maybe there's 1 or 2 people out there who saw this coming, but I would be very surprised. I know Bill Gates for many years has been concerned about something like this, but I don't think anyone knew, hey, 2020, it's the year of this crisis. No. But anyways, what I learned from this is things can turn so fast. And so we're seeing that already. We're seeing the stocks tumble. We're seeing people not able to go into work. We're seeing economic impact. We're seeing quarantines. We're seeing just unfathomable stuff. If you asked me, could you even envision that a few months ago? No, I couldn't. And so what I learned is because things can turn fast, there's kind of two takeaways for me. One, when times get better, I'll probably have an even bigger emergency fund than I did before. And the reason for that is I think negative events in this globally interconnected world, because we're all networked, they multiply quicker. And so a negative event 10 or 20 years ago, it wouldn't have the same impact as a negative event today, because the network, the strength of the network. And so because of the strength of the network, negative stuff, this virus, for example, it's multiplying faster, I think, than anyone would have imagined. Now, what that tells me is we, as a human species, got to be prepared for stuff, and we got to be prepared for stuff to turn quickly. And so that was one thing it told me just from an emergency fund standpoint. But what else I found is in the past, markets, I think we're going to see more volatility, and I think we're already seeing that. Like I said, I wouldn't be surprised if the Dow hits 15,000. And so what that tells me is my historic strategy of just dollar cost averaging, kind of even straight line over time, the right thing. It's served me well historically, but what I'm looking at going forward, and again, this won't help me during this crisis, but it will in the next one, is I probably need to stockpile a little bit more of a war chest. And what it means is my dollar cost averaging, it's not going to be so linear. What's going to happen in the future once we get past all this stuff, which may be 2 years from now, is I'm going to always dollar cost average in like I always have. But in up markets, maybe I'll dollar cost average kind of at half the speed. And in down markets, I'm going to save a war chest so that I can dollar cost average maybe at double speed, double time. And so for me, that was kind of a lesson that my linear dollar cost averaging, that kind of served me well in prior economies. But given that things are just kind of changing, the paradigm is changing, my dollar cost averaging, it's going to be more pronounced in down times and less pronounced in up times. And I'll tell you, during this downtime, I'm going for it. That's my personal journey. I don't know if it's the right thing or wrong thing. It may not serve me well, but like I said, it's in my DNA, dividends all day, every day. And so for me, I'm going for it. I'm going to do what I can to earn some extra money, preserve money as best I can to give it my all here in this down market. But when things start turning up, it'll probably be dollar cost averaging just a little bit slower. So that was lesson number one. Lesson number two, takeaway number two, I am so proud. And so there's a difference between an investor and a trader. Trader, they're like, hey, I'm buying and selling stocks. Investor, like myself, I own companies, and I own companies forever because I believe in the company. I don't care where the stock price is any given day. I own companies and I believe in companies and I want to hold them forever and I want to pass them on into the future. That's an investor. And so for me, there's companies that I own that have gone above and beyond, that are impressing me, that have literally brought a tear to my eye. I kid you not. Thugs can cry too. And I'll tell you, Walmart, shout out. 3M, shout out. Walmart rising to the occasion, working with the President of the United States, President Trump, to get the testing in their parking lots. God bless you guys. It makes me so proud to be a Walmart shareholder. Put the money aside. I don't care about the money. I want to invest in that because they're doing God's work, in my humble opinion. 3M company, working their hearts out to produce those masks, working harder, working factories 24/7 as much as they can to get the masks to the people that need it, especially the medical professionals. Bless them, bless their soul. Put the money aside. I'm averaging all the way down. I'm down on my position. I could care less. I want to put capital behind greatness. You might not even know this because this one doesn't get in the media as much, but Norfolk Southern, a railroad company that I own, I'm way up on this thing. They are putting plans in place so that the supply chain will work no matter what. This is the biggest railroad in the eastern United States. Without this railroad, people would not get the vital supplies that they need to live their lives. Norfolk Southern has plans in place. They have contingency plans. They have assured investors and stakeholders that their railroad will run. It will run flawlessly. It will run. And so bless their work keeping the supply chain going. And so one of my biggest takeaways out of all of this is, for me and in my investing, it's beyond the money. it's so beyond the money at this point. For me, I want my money behind greatness. And I'll tell you, in a time like this, I start thinking more philosophically. Like I said, I start thinking beyond myself. It's not about me. It's not about me being selfish. It's not about me. And so that's why I'm saying, like, dividend investing, I'm going to do it because even if I don't benefit, future generations will. Dividend investing, I'm going to do it because these companies need my investment because they're out there doing God's work, in my humble opinion. And so that's what has kind of come about in my own life out of all this, is just thinking beyond my own self, thinking towards the bigger picture. And so I'm just so proud. Walmart, 3M, Norfolk Southern, all the companies. I'm proud of Starbucks because of what they did in China to get things back to normal so quickly. And I'm proud of all the businesses out there. Most of the businesses I own, they're doing something one way or another to rise to the occasion, to put the people first, to put society first, ahead of profits in many cases. Not all cases, but many cases. And so blessed to be a dividend investor. So that was lesson number 2, and it just warms my heart. Lesson number 3, let's do this. Oh man, you're going to like this one. You're going to like this. I'm answering a subscriber question from a long time ago. People ask me, Ian, what stock would you buy? Which technology stock would you buy if you had to buy a stock or tech stock that doesn't pay a dividend? And I'll tell you, it's Google. We'll talk about this in a minute. In this downturn, I might fool myself. I might fool all of you. I might buy some Google, or Alphabet, if you will, what it's called now. I'll always call it Google. But I'll tell you. So one of the things I've learned about all of this is there's always been this dichotomy. There's the value stocks, and then there's the tech, the growth stocks. And I'll tell you, I'm learning as I go. I'm very transparent with that. I don't have all the answers. I got a lot of answers, I believe, and I've done well as an investor over the years, having done this for a long time. But I'm always learning, and I think one of the reasons I am a good investor is I'm receptive to feedback and to evolving. But one of the things I've evolved recently is I've always thought, hey, there's kind of the growth stocks and there's kind of the value stocks. And oftentimes someone thinks, like in a cyclical downturn or in a market panic, people go for value. They go for comfort. And a lot of my value stocks, I'll tell you, they're going to do very well. Like stocks like Procter & Gamble, Clorox, off the charts because everyone's buying up their supplies. And so it's a truism. It holds true in that case. But there's this parallel thought that, hey, the growth stocks, when time gets bad, they just get hammered. They get plummeted. That is not the case. If you look at something like Google, Amazon, Facebook, they're not cratering. They're not cratering nearly like something as a CEDAR FAIR. Why is that? Growth, value, I don't think there's the dichotomy that there once was. Surely there's certain growth stocks like the Teslas of the world that are in a league of their own, and I think they're not very defensive. But my argument and my lesson that I learned is that certain growth stocks, they're defensive stocks. And so I would have never thought this before, but you know what? Google, it's a defensive stock. It's a defensive stock, just like my dependable consumer non-cyclicals. Just like in bad times, people will always need the Clorox products. In our modern day and age, people will always need Google. They need Google search. They need Google products to work from home, to get the information they need, to order stuff online, to price compare, to do all kinds of stuff. They need Google. And so it's so interesting to see that a lot of these tech stocks, they've been weathering the storm very well. And it's taught me, look, I invest for dividends and cash flow. I want to use my dividends to pay all my bills. I'm already using them to pay some bills. But I shouldn't say never. I shouldn't say never on the growth stocks, because I would not be surprised out of all of this if it gets low enough, I may pick up some Google or some Alphabet, if you will. And so I want to pop that on the screen really quickly. Actually, I'm going to do this really quick. Google, I like the GOOGL shares, or the Alphabet shares with that ticker, because it's the voting shares, but they have the other share class, just GOOG. They're both fine. Check this out. The PE, main thing I want to show here, the PE forward is a 22, and the 2021 PE forward is a 19. Debt is really low at $15 billion. That debt is nothing given their market cap. They have less debt than 3M. They have less debt than Starbucks, even though their market cap is orders of magnitude larger. And so you see a very stable company here, a very defensive company, a company that people will need no matter what. And so not all tech companies are this way, but they don't pay a dividend, and I don't think they will. But that being said, I've got my eye on you, Google. But then the other part of me says, Ian, if you're going to deviate again, like you did with CEDAR FAIR, from your ride or die stocks, at least you should entertain a stock you already own. Do you really need 45 positions instead of 44? And so then the other voice in my mind got me looking at Apple. I have some Apple stats here as well. And comparably, Apple's PE is lower. On a 2020 forward basis, it's a 20.6. 2021, it's a 17. But Apple's got a lot more debt. So on that standpoint, I'd say Google is in a better position from a debt standpoint than Apple. Apple is in a better position from a valuation standpoint. From a growth standpoint, we shall see. I think they're both high growth companies, and they could both continue to grow quite well in good and bad economies, quite frankly. But that's also kind of a takeaway there for me, is that, Ian, if you're going to go that Google route, should you just entertain first adding some more Apple? We'll see. I'll tell you, I'll probably break my ride or die rules again. I felt bad the first time I broke it, but then, look, members of the community kind of reminded me, and this is why I love this community. We're all collaborative. They're like, Ian, your rules, they're just a guideline. And I agree. That's why I did it. That's why I bought the CEDAR FAIR. But that said, most of the time I got to follow my rules. But if I'm going to break my rules again, does Google make sense or Apple? I'll probably stick with Apple, but we'll see. You never know. If Alphabet trades down enough, I've had my eye on it for a while. This is the one. This is the one non-dividend stock I really would love to own. And so, lot of interesting stuff with our changing world. Our changing world, in some respects, because of this particular way the world is changing with this virus, is we're becoming a little bit more isolated, and that's where technology really shines through and plays a valuable role. Okay, so I want to move on to my next lesson. Check this out. Colgate. Colgate raised their dividend just recently. Not a big raise. They increased it just a little bit by 2.3%, but Colgate raised their dividend. It's a dividend stock that I own. I love this company because it has a lot of exposure internationally, brings international exposure to my portfolio. Even in the worst of times, some companies will be able to increase their dividends, like Colgate. And so people ask me, Ian, this year, are you worried that all your stocks will cut dividends? We'll talk more about this later, but in general, no. I expect my dividend income this year, on average, to increase. Some stocks may cut it. Others will raise it. Some will be flat. I own enough stocks like Colgate. That's where I've actually got the lion's share of my money is in consumer non-cyclicals like Colgate, that it should help me weather the storm. But just shout out any company, if you are willing to increase your dividend during these times and you feel confident doing that, bless you. Your shareholders, we love you. We really do. And so it's just really refreshing. I said this in another video. I don't know how to get through a crisis of this magnitude, unprecedented, with any strategy, quite frankly, other than dividends. And not only dividends, but high quality dividend stocks like the Colgates of the world that can actually increase the dividend during the downturn. And because I don't really look at share price, I don't really look at portfolio value, I'm just looking at cash flow, I expect my cash flow to steadily increase. Now, will it be slower during 2020, maybe 2021? Yeah. It will surely grow because I'm adding more money to the mix, but even on a constant basis, say I don't deploy any more money, the income should grow, even not even counting reinvested dividends, because I expect on average companies that I own, especially weighted average, because I have a lot more weight in stocks like Procter & Gamble and Clorox, those types of companies, I think they will continue to increase the dividend right through the global crisis. And so that is why I think dividend investing is so thug life. It is such a great investing strategy for all types of markets. Okay, another takeaway that I learned is it's tempting. It is so tempting during the downturn to buy the risky stuff, because the risky stuff is what's cratering. It's the Carnival Cruises of the world. It's the CEDAR FAIRs. It's the oil stocks. And I've mentioned this already in prior videos. My strategy is the ride or die stocks. The reason for that strategy is to safeguard myself. The reason for that strategy also is to just buy quality. If everything's going to start going on sale, why not buy quality? That being said, it's a temptation for dividend investors, and I even fell into the temptation buying some more shares of CEDAR FAIR. And so it's just a lesson that human nature, it's tempting to go after some of these deep discount sales, but I have to remind myself in the oil stocks of the world, the travel stocks of the world, those types of sectors that are getting hit so hard, there's a lot more concentrated risk with those sectors than many other sectors. And I just have to remind myself of that, not to get too drawn into those values, because a lot of those could be yield traps. And I wouldn't be surprised for dividend cuts or suspensions in certain of those sectors, certain of those companies. We saw it with Occidental, but that's no surprise in my humble opinion. I talked about that in a recent video, although I wish everyone in Occidental all the best. But again, even I fell into that that trap. I bought one stock that wasn't on my ride or die, and I was kind of drawn in because I saw just how much it was plummeting. And so everyone should be aware, in my opinion, just of the psychological side of things, and also that it's important to have a plan, a real solid plan. And your plan probably going to be a lot different from my plan, but by having a plan on paper, at least it guides everyone in the right direction. And some people might have a plan, don't buy any stocks, need to build up an emergency fund here. And that's a different type of plan. And it may be tempting to buy stocks, but it's, everyone's going to have their own situation. All right. So last takeaway, apologies again for production quality here. I've had to keep taking some pauses here to kind of blow my nose as I've got a head congestion here, head cold, that I'm trying to power through for this video. But let me go through now my ride or die stocks. And the reason I want to do that is I want to show you the premium stocks, more or less, they're still not on sale. And so this is a takeaway that I can't emphasize enough. The premium stocks, they're just not on sale. It's a lot of the riskier stocks like the CEDAR FAIRs of the world. Let's check this out. Check it out on the screen. Johnson & Johnson now is on sale at a 14.94. I'll probably be picking up some of that. But check this out. Pepsi, PE is over 20. McDonald's over 20. Clorox, 27. Duke, hey, 16 is okay, but for a regulated electric utility, I'd say 14. 12 to 14 is more value. It's not a value yet. Procter & Gamble, almost 23. Coca-Cola, 21. 3M, this is starting to be a value, but I believe that PE is misleading again because I think earnings are going to be worse than are based in this forecast. Kimberly-Clark, I highlighted because it's finally getting into a sub-20 PE. If it were down at 15, I would call it a value. Starbucks, not a value yet, but I buy purely based on stock price because it's tanking. Home Depot, at least it's under 20, but it's still not a deep value. And so you see here, and Realty Income I don't include here because PE doesn't mean much for that. It's a REIT. But if I average the non-REIT stocks here in my ride or die, I get a PE of 20. A deep discount market, I would bet that these types of stocks, the average should be more around a 15. And so all I'm saying is a takeaway for me is, Ian, don't deploy your money too quickly. Ian, be patient, wait it out. With these unprecedented times that we're in, your quality stocks, they're still not on sale. And so it's good to average in and pick up shares, as I have been, especially in stocks like J&J, 3M, those types of ones that are on sale. But most of these, like Ian, you're buying Starbucks, it's probably a fair price. It's not a deep discount. It might be even overvalued. And so I just have to be mindful and honest with myself that the quality stocks, they're still not on sale, even though the market keeps tanking. And it probably will tank more, in my humble opinion. By the way, I just want to point this out as I transition now into the next phase of the video. Things are, in my opinion, going to get worse. They're going to get worse because people are at home. There's going to be more people, unfortunately, affected with this nasty disease, with this nasty virus. Economic activity is going to grind to a halt, and it already is. It's not even showing up yet, but when these companies start doing their reports, earnings are going to come in bad. They're going to be horrible. Unfortunately, and my heart goes out to anyone who may be affected by this, there could be layoffs. It would be horrible, but it's something I could envision happening out of all of this. People are going to be spending less money, and so companies will be making less because consumers are going to be more cautious. And so what I'm trying to say is there's a long-lasting economic impact of all of this. And that being said, the stock market, The stock market is a forward-looking entity. And I still don't think all the downside is priced in, but let me tell you, let's say it takes us 2 years to get through this recession. Let's just say it takes 2 years, 24 months. In my opinion, within the next 3 to 6 months, the market, I think it'll bottom. The reason, and then it'll start going back up, it'll tank, it'll go back up, it'll start its journey back up. And that's why next 6 months, I'm really looking at the market very closely because my timeline is forever. I want to average in. And when it starts rebounding, I'm probably averaging a little slower. I'm going to get ahead of myself here, maybe just a little bit on the way down, but on the way up, I'm going to go real slow. And in the future, that's what it's going to be. It's not going to be linear dollar cost averaging for me anymore. But the reason I want to point this out is I want to now talk about forecast. What do I think is going to happen? What am I preparing for? I could be completely wrong, but this is just what my intuition tells me, what my experience tells me. Stock market is forward looking. Because it's forward looking, and the market, it's going to bottom before the economy does. Because the market's going to know what's going to happen in the economy. Stock market, people know what's in the future. We're going to see it. And so at a certain point here, stocks are going to get low enough where all the bad news is priced in. Yeah, Starbucks, for example, it's not going to announce its full year 2020 earnings until a long time from now. Market is not going to price Starbucks at its lowest point when that earnings report comes out, in my humble opinion. The market's going to anticipate, hey, Starbucks is going to have a really bad year. We think it's going to come in kind of about here. Let's price the stock accordingly. And the pricing of it, it's going to happen well before the news, the actual news comes out. And so for me, that's how I'm kind of preparing. I think a lot of people are waiting and they're thinking, oh, it's just going to keep going down for 2 years. Probably not, because I believe the market, it's a lot more efficient than it used to be. This goes back to the network. We're a global network. Look at this community, how smart we are. We have all kinds of people on Facebook, YouTube, sharing all kinds of data points. Because of the network effect, the market is more efficient probably than it has been in the past. Because the market's efficient, it will price the downside well before the downside in the actual economy happens. And so for me, that's one of the reasons I'm going a little heavier in my buying right now. Am I taking on a lot of risk? Heck yes. Am I a thug life investor? Yeah. And so I might be in a class of my own as it comes to risk tolerance, but that's just my journey, my story. And so that's one thing I want to talk about with the future forecast. I also want to talk about some other stuff. I already did this, but Dow, I think it's going to hit 20,000. That's in a good case. In a bad case, it'll probably be in Dow 15,000, somewhere in that range. Will it go below 15,000? Probably not. But once we kind of get to Dow 20,000, that's where my buying, I will do what it takes to buy. And I'll tell you, I love this comment. I had a subscriber recently put a comment. I don't know if this was the truth or not. I hope it was, because I love this. This is the most thug life thing that someone has ever put. But they said, look, Ian, I am standing in front of the furniture store right now, twirling one of those signs. You know, have those signs, and they have those people that can kind of make it go crazy to draw attention to the store. He said, I'm doing that. I'm making this much money per hour, and after 5 hours, I can buy this many shares of my favorite stock. And so that's a hustler right there. That is someone on the hustle making money for dividend investing. And that's kind of how I view myself now, is during these times, I want to be a little more scrappy. Every month is frugal February for me. And when the Dow hits 20,000, if it does, if I'm right, I'm going to be even more frugal February, like frugal February +1 or something. I'm going to go kind of all in, try to be scrappy to get more money to be able to deploy in the market when it's down, because I know the market's looking towards the future. And I think most of the downside within the next 6 months, the market will be smart enough to price it in. But at this time, just looking at the valuations of my ride or die stocks, averaging in above 20, I know the economic downside is not priced in. Oh my goodness, it's not priced in. It would be if that average PE were somewhere between 12 and 15, but at a 20, it's not priced in. No way. So the market still has some catching up to do, in my very humble opinion. Okay, I want to talk about dividend cuts. And so shout out to one of my friends at home who brought up this idea, my man Don. I hope you're watching, Don. He brought up this point to me via email, and I thought it was interesting to share. Flat out, I think dividend cuts are going to happen in certain industries. This is before I get to Don's point, but I think certain industries like oil, amusement parks, cruise lines, hotels, airlines, that kind of stuff, dividends going to get cut. It will. Be prepared. And I own some of these stocks. I own CEDAR FAIR. I'll give you another example. I own Realty Income. It'll be interesting to see what happens with Realty Income because they own triple net lease company. I don't know if some of the gyms, fitness facilities, how well they're going to do during this era. A lot of people might be working out from home or just going running these days, or not doing it at all, sitting home, eating products from one of my favorite holdings, Coca-Cola or Pepsi, eating their fears away. I'm guilty of some of that. Who knows? But all I'm saying is there could be a ripple effect even on companies like Realty Income. I don't know. I don't know if our world moves to more virtual offices, are people going to be renting office space the way they were? And so there's certain, I don't want to strike fear. I don't know what's going to happen, but I'm just prepared. There's going to be dividend cuts. There's going to be cuts in my portfolio. But like I said before, net, my income will go up year over year, even on a controlled basis, not counting reinvestment, not counting more capital deployed, because of the strength of my core. Because I have so much of my core in stocks like Coca-Cola, Pepsi, Procter & Gamble, Kimberly-Clark, Clorox, Unilever, those types of stocks. And so for me, I'm ready for the cuts, but and I'm not selling. I just don't sell. I'm not doing it. But I'm being careful to deploy money now because, look, I just deployed more money at CEDAR FAIR, which is a company that might have to do a cut. I don't want to create alarm, but it's possible. So that's point one on the cuts. But another point that I want to bring up is from my friend Don. And what Don was saying is, Ian, look at interest rates. Interest rates right now are at historical lows. Bonds, the yields are next to nothing. What does this all mean for dividend stocks? Dividend stocks flat out don't need to pay the yields they used to. They can lower their dividends, save up some cash, and still offer a compelling yield as compared to the alternatives like savings accounts or bonds or really anything. And so I thought that was an interesting point, and I think it's something worth mentioning that philosophically, companies may not have to pay the dividends they used to pay. Now, that all being said, I invest in companies that take pride in their dividend. I invest in companies that are dividend aristocrats, which means they consistently raise their dividend year over year over year for 25 years or more. And so because I invest in those types of companies, I don't think the aristocrats are going to be cutting dividends unless they have to. And so it's possible, but I think Don's point may apply to the market overall, to other pockets of the market than the aristocrats. Certain companies philosophically, yeah, they might be like, look, we just don't have to pay it out. And look, times are uncertain. Let's conserve a little cash. And so that I thought was a valid point from my friend Don. But for me, for the types of stocks I own, which are really premium dividend stocks that tend to take pride in raising the dividends through wars, through depressions, through recessions, I don't think I'm going to see dividend cuts in companies like Coca-Cola, for example. I just don't think so. I don't. But companies like amusement parks, it's possible. And so that's how I'm looking at it. Now, how do I react to all of this? Like I said, I'm dividends all day, every day. It's who I am. It's what I do. I'm looking at the long term. I'm probably in a very different situation than a lot of people in that my timeline is forever. I want to enjoy the passive income in my lifetime. I expect to, but for me, this is just what I do. It's what I do. And so for me, with that kind of mindset, company I own cuts the dividend, I'm not going to abandon them most likely. I can't guarantee that. As long as I see like a path to it coming back, like I would actually advise some of my oil companies at this point to cut it temporarily to shore up some extra cash on hand. I would feel good about that, and I would hold them. And so that's how I look at dividend cuts. But yeah, that's kind of my forecast here. I think I'm not, again, I don't want to spread fear. I don't want to spread doom and gloom. What I'm trying to do is spread a rational, even tempered perspective. Someone who's been in the stock market for a long time. This is why it's hard. This is why stock market investing is not for everyone. This is why it's hard to be successful as a stock market investor, because it can get emotional, because times can get pressing, because times can get uncertain. And as investors, we have to find a way to best navigate. And so I'm sharing in the video today my rational approach to navigate it all. And it's not all brightness right away. It's going to be a long turnaround, in my humble opinion. Will the human species prevail? Heck yes. We're going to figure this thing out, and our society, our investments, our economies, they will skyrocket to new heights. Now, I just don't know when that's going to happen, but I'm willing to wait it out and see how it goes. And along the way, feel really good about supporting companies like Walmart that are doing amazing, amazing things out there. And quite frankly, companies like Johnson & Johnson, AbbVie, I hope those holdings of mine help find the cure for this awful virus. Now, before I leave, again, if you're facing health issues and you want me to pray for you, please share in the comments below. This is a community. I hope we can all come together. And I've said this on my Facebook group. I'll say it here. I have zero tolerance for people during this time putting anyone down. And so if you're going to go in the comments and put people down, I just got to remove the comments, because this is my house. There are no shoes in my house. My house stays clean and pristine. This is a place of collaboration, of kindness. Now, obviously, if you have a different opinion than me, please share it. I love that. I love to learn. All of us love to learn here. We'll do that in a cultured and mature manner. But people trying to put others down during this time, it is just absolutely not going to happen in my house. And so I got to throw that out there. And so that said, much love and respect to all of you that are following the rules and are keeping it professional and have a heart for everyone out there. I love you all. Before I leave today, in terms of a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment. Now, before I leave, I also want to share a full disclosure. I own the stocks mentioned today, and so this will take a while because there's a lot of them, but I am long Walmart, ticker symbol WMT, Colgate, ticker symbol CL. I am long 3M, ticker symbol MMM, Norfolk Southern, ticker symbol NSC. I am long CEDAR FAIR, ticker symbol FUN. I am long Johnson & Johnson, ticker symbol JNJ, PepsiCo, ticker symbol PEP, McDonald's, ticker symbol MCD, Clorox, ticker symbol CLX. I own that one as well. Duke Energy, ticker symbol DUK. Procter & Gamble, ticker symbol PG. Coca-Cola, ticker symbol KO. Kimberly-Clark, ticker symbol KMB. Starbucks, ticker symbol SBUX. Home Depot, ticker symbol HD. Unilever, ticker symbol UL, AbbVie, ticker symbol ABBV, and Realty Income, ticker symbol O. I own all of those stocks in my personal dividend stock portfolio. Stay tuned, everyone. I'm going to do an update on my overall stock portfolio soon. It's been a while since I've shared my updated stock portfolio with everyone. I'm going to do an update to see how I've performed versus the last update. That'll be really fun and exciting to share, so stay tuned for that. If you enjoyed the video, please subscribe, like, comment. It means the world to me. I love you all, praying for you all. Let's come together as a community. We can do this. Let's thrive as dividend investors and just humans out there. Do our best in face of absolutely unprecedented, unfathomable times. At least that's how I look at it. I'll see you all in the next dividend investing video.